Good morning, ladies and gentlemen. Well, the risk dial keeps on improving. It's minus 23, which some people might not think is a huge improvement on the week, because as we can see, we started off minus 27, but we closed at minus 23, which is actually the best that we've been in, best score since March. Since early March, and we are actually talking about we're talking about March the 6th to March the 7th. This is pretty damn good change in the score. And if we look at the weeklies, we also see that this is the best weekly score since exactly that period. We will see here that in March it started rapidly deteriorating at end of September, and then in March it started deteriorating from minus 22 into the minus 50s, and then into the minus 70s and minus 90s. So it is getting better. The situation is getting better, and I think it's time to actually examine what the consensus is, because the consensus is very bearish at these levels, and see if that actually makes sense, and what potentially a plan B could be, what else could happen to actually make us go very, very positive over the course of the next few weeks. I'm with the with the flock of sheep, thinking that these levels are pretty damn toppish, but I'm perfectly open to price telling me that I'm wrong and that the market for risk is going to go substantially higher. If we look at deviations, they're actually saying the same thing. The center line is turning upwards, and there is quite a bit of room to go to get to the red zone. You can see what the market did here. It always goes up to the red zone. So where is the red zone? Here it is, 311.5. What's that? That's 31.10.15 on the S&Ps. That is what deviations are saying, that there's plenty of room. If we look at the individual sectors, we will see that some of them are still wildly oversold, but most of them are at the middle line and turning the middle line, saying that the trend is getting better. This is XLB. Even materials are saying that, which should be down here somewhere, are saying that the things are getting better. XLK naturally is the one that turned it first, but even XLK is saying that it's not hugely overbought and it has some room to the upside. But the ones that have been hit hardest, which is XLF, even those have quite a bit of room to the upside, and even they are slowly turning the center line, which says that at worst we're going to have moves down towards this kind of level, but it's not looking that bad. I am personally shocked by how not bad it's looking. XLV could actually make new highs without too much problem if it breaks these highs that it made back in March, April. A break of those highs and it sees it making new highs. XLP situation not bad, turning the moving averages. XLY, it could easily spike up to somewhere near the old highs. XLI, even that one is turning the center line. This is what's bothering me. I am thinking that the market should top out here, but there are absolutely no signs of price confirming it. In fact, there are plenty of signs of price not confirming it and saying the opposite. So what I want to do is I want to examine possible scenarios and triggers of what will be saying that actually risk. Well, this will be a shocker to you, but I believe one of the first signs is going to be the yield curve. It's not like I haven't been saying it forever, but 2s 10s keep on being here at around 53 to 55. They keep on trading at this level and not backing off at all. If we are to see any kind of pullback in SPY or risk in general, you would expect a flattening of the yield curve back down towards 35 basis points or 30 basis points, and looking to break lower as the yield curve flattens, as people run out of risk. The opposite is happening. It's okay, it's not breaking the 53, 55 area, but it's not backing away from it either. Is it building momentum to break and go up towards the 75 area, which would be very, very significant? That to me would be the first sign. If we start closing above 55 basis points, I start getting bullish on risk. This is the 5s 30s, which is actually even more bullish for risk. And I'll explain this scale because it's counterintuitive. This is not -4, it's 40 basis points, this is 60 basis points, this is 80 basis points, this is 100 basis points positive. Now you will see that actually in 2020 the curve has steepened. What does that mean? That means that the differential between 5-year notes and 30-year notes has actually gone out. As the Fed has eased, and 5-year notes have gone a lot further down in yield than 30-year notes. Now you would expect the trend to be back up towards the 80 and the 60 here. That is what you would expect. In fact, it's sitting at 100 to 105 basis points, which is this very, very important level here. If we start now breaking down, I think we will go all the way to 154. That is a 50 basis point move in the differential between 5-year yields and 30-year yields. What would that imply? Well, why would 30-year yields be rising relative to 5-year yields? The only explanation would be is a return towards risk on. 5 years and 2 years are going to be anchored by the Fed easing and no movement from the Fed for the foreseeable future while QE keeps on going on. But if the 30 years now start backing off and basically going from 130 odd basis points to 180 basis points, which would actually be while 5 years do nothing, which would make this line come here towards 154, that could only be because risk is on. And the fact that we haven't been able to go upwards has me scared. Has me scared that I'm misreading the situation completely, and that I should be not only fully invested in risk, but I should also be leveraged in risk. And I'm not fully invested and I'm not leveraged. So that is, to me, a trigger. We're so close to it. Any weekly close now below 100 and i.e. above 105, 106 basis points, and it's telling me that we are going to go over the course of several months to 154 basis points, i.e. a much more positive yield curve. And a much more positive yield curve at this stage in treasuries can only mean that the market wants to go risk on. SPY over IEF. IEF is the 7-year area, 7s to 10s, let's say. Now, if we go above 250, and this is the period in early March from which we absolutely collapsed, if we start going above 250, you can see how important a level that has been throughout the years. We are likely to start going up towards this level here, 275. Now, this has got a big alert for me, because if we start breaking that, we are going up, and that can only be described as very strong risk on. in exactly the same vein, and with chiming in with what I was saying about the 530s as the yield curve, this is SPY TLT, which I've shown you many times. Well, it's getting very, very close to this 183 and 191 area. Starts breaking and going up towards 2 in the 200-day moving average. This is the area in early March when we were trading 3100. 3100, 3200. It's there. Starts breaking above this line. I think that we go to this 61.8 retracement around 2, and the highs that we were in late February, early March, which is somewhere around the mid 3100s. Could that happen? Absolutely. It's looking more likely than not, in fact, I would say. And that is why I'm so scared of having a bearish view on risk, because nothing that I'm looking at is really confirming that we are in that kind of an environment. I don't know why we're all so bearish. I just don't understand it. I would be, if I had fallen from Mars today and I was looking at the charts and somebody asked me which way are we going for risk, I would say we're going up. I.e., if I had no confirmation bias, no knowledge of what had happened until now, no knowledge of this virus, I would be saying that the price is indicating that we're going to do better rather than worse. That is what worries me. I would like to be bearish with the crowd, but I just can't be. I can't be because nothing is telling me that I'm right at this level. As you know, I think everything is in the spreads, and if we use our logic, if things are going to get better, they're going to get better because the XLI, which is this chart over SPY, or the XLF over SPY, are going to rally. We cannot keep on doing better because just defensives do better. We have to have the underlying economy do better, and that will be reflecting in XLI and XLF. If the situation is better than we feared, the banks will start doing better and the industrials will start doing better. What trigger level is that level? Well, it's quite clear. These lows were made on March the 23rd in the relative price of XLI and XLF over SPY. And that is when the market bottomed. Okay, this is when SPY bottomed, but you can see that the relative spread is still below those levels in both of them, much more so in XLF, which basically means people have been selling XLF, selling the banks, selling the banks, selling the banks, because they fear a flat to negative yield curve. What in effect has been happening, where I showed you the chart of the 530s, I showed you the chart of the 2s, 10s, the market, the yield curve has been steepening. Now, these two facts just don't go together. If the yield curve is steepening, that means that the bond market is saying that we are not going to have such a bad situation. So, to me, the trigger point is going to be this 0.21875, 0.07921 in the relative levels. If we start breaking above the low that we made on March the 23rd, I think that the market in XLF relative to SPY and XLI relative to SPY can actually do a moonshot. We can go to 23, and here we can go possibly all the way back to 80, to 0.089, where this moving average is and where these lows are. That will tell me that the rally in SPY is the real deal, and that we're getting huge rotation out of the fear sectors. And I would say that XLK at the moment is the fear sector, and the market will start anticipating much better earnings from XLI and XLF. I think it's incredible to believe that the economy can get better without a huge moonshot from the banks, which have been sold to absolute shit, pardon my French. And that's why I'm looking especially at stocks like CAT and JPM to give me a good steer over the course of the next several weeks. They have been very weak, and last week they didn't make huge improvement, but that can change on a dime. And these are the sectors that I would expect, and these are the spreads that I would expect to break these levels and head substantially higher. Do something like this in literally 2 days. What happened, between the 23rd and the 28th? A huge rotation into XLI and into XLF out of XLK, most probably. What is it that makes me fearful that such a rotation is possible? Now, I'm not saying any of this is going to happen. I'm just saying that I'm fearful that it might. And naturally, that would completely destroy my bias, which is that the market is very toppy at these levels. Well, the first thing that tells me that it's possible is the Nasdaq is above the monthly Bollinger Band or at it. In fact, we traded 3 days, sort of up and down around that 94.10 area where I liquidated my longs in technology stocks. Didn't go short, but I don't see the risk reward in being long of them. Well, if that happens, that assumes a rotation out of technology. So either everything is going to collapse back down, which I don't see the reason for, or there'll be a rotation out of technology. Now, a rotation out of technology is bullish for SPY and probably neutral to small down in Nasdaq. It's one of the possibilities. It's telling me that why would anybody keep on buying this market when it's at the top of the monthly Bollinger Band and so close to the all-time highs? Well, if things are so good, why not buy something which has really been beaten down like the banks or the industrial sectors? If you confirm that, if you compare that monthly chart of Nasdaq to the one of S&Ps, well, the underperformance is absolutely obvious, right? We have room to go in the S&Ps all the way up to 3,270 before we touch the top of the Bollinger Bands. Am I saying it's going to do that? No, I'm not. I'm just saying that the potential for a squeeze is much higher. Now, does that squeeze only go to 3,028, or does it go all the way back up to the to 3,300-ish? I don't know. I'm just very aware of the possibility that such a rotation might take place, and that would actually explain why the market is doing what it's doing. I'm just looking for possibilities and signals of what will make me think that my macro view is wrong and that I have to rotate into SPY and risk in general. Just what I'm seeing, just what I'm fearful of, but those trigger points in those spreads that I've shown you are very, very important, and if we start trading through them, and especially if we start trading through them in all of them, that will really tell me that the market in SPY is ready to run. All week last week, and this is a weekly chart of SPY, SPX, I was waiting for a breakdown from the 29.54 level down towards the 28.64 level, and the test of these moving averages right here, where probably I was going to get slightly long. It didn't happen. It absolutely didn't happen. Well, let's look at what the market has actually done over the past several weeks. We went up to exactly 29.54, backed off hard, just stopped short of the 27.20 level that I would be bullish at, really bullish at, closed the week exactly on top of 28.64, and then gapped up and actually exceeded slightly 29.54, and Nothing. We just could not cover, go into the break at all. Left a gap, closed very much, near the highs for the week for no reason whatsoever. It's not the stuff bear markets are made of. That kind of price action tells me that next week probably 30.28, and then we see. But it's unlikely to stop there unless we see no rotation. If we see no rotation from XLF and XLI, as I've shown you before, and all that happens is that NQ goes slightly above the monthly Bollinger, then goes back to the monthly Bollinger, yes, then all we're going to see is probably a rotation back up to 30.28 and a back off, straight away. But if we start seeing those signs that I've shown you before, and that's why I think they're so important, I think 30.28 doesn't hold it. I think there's something very, very big going on, and we might see one of these trends all the way back up to, I don't know, filling even this gap around the 3,300 area. I don't know why that would happen. Could it be something to do with a virus? Could it be something to do with a cure? Could it be something to do with a vaccine? Who the hell knows? All I'm saying is that the spreads are telling me to be very wary. And the other thing that's telling me to be very wary, here we are for the first time in a long time, ever since up here, okay, we have got a positive MACD on the weeklies. It's a small sign, it's a technical sign. I wouldn't put all my eggs in one basket because of it, but it's yet another sign that tells me that this, sort of, my God, we're going to fall apart, everything is awful. This narrative is just wrong, just rubbish. And that is what actually makes me fearful that I'm very underinvested and that I need to get a move on and buy some risk. But as always, I'm going to be guided by the spreads. If those levels start breaking that I've just shown you throughout the video, we are very, very far away from the narrative that everybody subscribes to, and we are going to smash it to smithereens. To end with, always look at all the markets for confirmation. On the left we have DAX, on the right we have the stocks. These have been the weakest markets, and they're actually the ones most weighted towards the sectors that have been doing the worst, i.e. that I explained to you, the industrials, the financials, that kind of stuff. So if they rally, it makes sense that the S&P is going to rally too. I think that the DAX has got 11,700 written all over it. The fact that it just could not keep on breaking low and it just keeps on, going up, telling, with these moving averages and the weeklies actually ticking higher last week, tells me that DAX has got 11,700 written all over it, and that possibly the weakest of the weak stocks has got 3,085 written all over it, at least. Would not be surprising to me at all. And that is, that's how many? That's nearly 200 points in the stocks. That's what, 7%. It's not to be sneezed at. This is what, 700 points, which is around 6% in the DAX. Absolutely not to be sneezed at. That would probably, say S&Ps go up only 5%. Well, that gives you 150 higher than when we closed. What is that? That's 3,100 on the S&Ps. Everything is telling me that I'm wrong in being so defensive. I don't know, but I will definitely next week keep on looking at the spreads and and be guided by them, because I'm getting fearful that we need to be a lot longer than we are at the moment. Thank you very much indeed, and tweet you Monday bright and early.